Is Canada in trouble, and is the new federal budget going to save us? Hi everyone, Ian here. So recently, as we can tell from the GTA real estate market, that the market is slow. Despite the interest rate cuts in September and October, especially after the October rate cut, the market has not recovered. And we want to take a look at the bigger macro picture to see why Canada seems to be in trouble as a country, and how that's going to affect our mortgage rates and the real estate market, and is the federal budget, can it help us? So on the screen you can see that there's talks that Canada by March 2026 have 1 in 3 odds of recession, right? So Canada next year, 2026, does not look like the economy is getting any better based on economic analysis. And the more concerning one to me is that Fitch, the rating agency, has warned Canada of credit downgrade. We are currently, I believe, AA+, right? And they're thinking of downgrading Canada as a whole, credit-wise, from AA+ to AA, right? Which is a big problem as a country, especially for our mortgages, right? Because Fitch outlined 3 core concerns on Canada's credit as a whole. They're saying that Canada has a large deficit of 1.2% of GDP, which is double the pre-pandemic average, right? So our deficit is getting bigger despite our supposed recovery after pandemic. And the gross general government debt is projected to hit 111% of GDP by 2026. Okay, so debt is just growing at a speed that's too fast, right? Like comparing to our GDP, and that causes concerns. Just like how we evaluate somebody's mortgage profile. If they're borrowing too much against their income, there's a problem. We don't want to lend them the mortgage, right? Same thing as Canada as a whole. So far above the AA median of 45%. So that's why they're considering downgrading Canada's credit from AA+ to AA, because too high. We're just borrowing too much, and no path back to fiscal normalcy. So there's no plan. Like there's no good plan that the government has proposed. How do we reduce the debt? How do we reduce the deficit? No clear plan, right? And that's why, we're asking, hey, didn't we have a recent federal budget? Isn't that going to help us? And the answer is that this is a very personal opinion, right? Everybody may have a different feeling, but my personal feeling is that this federal budget is more like, how do we deal with Canada? How do we deal with our economy while Trump is in term? Okay, how do we last until Trump is gone? Like, what are the temporary and patch solutions? It's kind of putting on a band-aid, right, on our economy and to last until Trump is gone. In this whole entire budget document, there's so many places that's kind of inferring to Trump. Okay, even though it doesn't say like Donald Trump's name in it, but it's referring to a lot of incidents of what's happening because of the current US policies and trade policies, and how we as a country is reacting to that. And that's just, it's a reactionary type of policy. And you can see that the projection for 2026, okay, next year's deficit is negative 78 billion, okay, negative 78.3 billion. And that is a bigger deficit than what we have today. And also, because you have a bigger deficit, that usually means that, hey, the government needs to borrow more, right? And therefore our borrowing cost is going to increase, which puts more pressure on our financial system. And it seems like the government has came up with creative ways to make it seem better than it actually is by using short-term debt, like T-bill balance, right? Like, it has increased so much. The government is saying that, okay, we have a lot of deficit, we need to borrow more money, right? But we don't want to increase our debt like interest too much. Okay, we want to make it temporarily, at least for now, seem like we're doing okay. So instead of borrowing the more expensive long-term debt, let's borrow short-term debt instead, because short-term debts are cheaper. But it's just kind of pushing problem to next year, right? Because short-term debts, they mature quickly. After 3-6 months, what happens when these cheaper short-term debts mature? And then the government is basically saying that, okay, you know what? Canada economy is bad anyways. By the time these short-term debts mature in 6 months, because economy is so bad, nobody's buying anything, our natural inflation rate is going to be down. So therefore, when we roll over to new debts, because bond yields is tied to inflation expectation, so because at that point, our economy will be even worse than today, so inflation expectation will be lower, so we can roll over into cheaper long-term debts. So it's kind of like, almost like the government is betting our Canada's economy will be bad next year, so that when it rolls over to the long-term debts, we're going to be still able to borrow at a cheaper debt rate. But today, if they borrow long-term debt and locked it in, we'll be paying too much interest. We'll be having too much kind of leverage pressure, right? So that's why, and that's going to draw criticism to the government. So that's why they're kind of shifting the problem to later. And that's what I read from this budget, which I'm just thinking, man, next year is going to be like a clown show, right? Like what's going to happen next year? Who knows? And for real estate purpose, because we're already not having a good market, okay? And people don't care about Canada already, especially our real estate market. You can see the real estate percentage of investment comparing to our Canadian families investing in stocks, it's going down, right? From 46% to 39%. It is coming down, and stocks has increased from 21% to like a quarter, 25.8%, higher and higher. So people already don't trust Canadian real estate as an asset. And if the government is still kind of not doing anything to boost confidence and kind of shifting problems to later and counting on our economy to be even worse, and also saying that, okay, we're done with rate cuts, I don't see how that can help our real estate market next year. Okay, so that's just, my worries. I mean, hopefully, like I'm a realtor, I want the real estate market to boom, I want the price to recover, but I just don't see it. I just don't see any data that can tell us, right? I mean, in the budget, there's a lot of talks about investment, because in the past, you can see that investment per available worker, like business investments into our economy, you can see per available worker, okay? US has really out-invested Canada for the past, especially the past, I would say 10 years. Okay, ever since 2015. Before that, it's about the same. You can see it's very similar. But after 2015, level of investments in US and Canada on a per person basis has really widened. Okay, and that's a problem. That means just we're not investing, we're not attracting enough foreign investments, and this gap is getting bigger and bigger. It's like a rolling snowball, right? Like the more attractive you as a country attracts investments, the better the country performs, the better the economy is, and attracts more investments. It's kind of a reinforcing cycle, and Canada is just, kind of a vicious cycle, right? That the less you invest, the less productive you are, the less people want to invest in you. So that's why, I'm seeing that if the government is counting on our next year to be doing worse in order to save the rollover of the short-term debt to the long-term debt, then our economy is unlikely to be better. Let's say our trade war with the US stops today, okay? And just no more trade wars, everybody's happy, economy gets better. Okay, so next year when the debt rollovers, it's going to, because economy is good, demand is higher, right? So we're going to expect higher inflation. And when higher inflation, then borrowing cost is going to be higher because bond yields are tied to inflation expectation. So if our economy is good next year, then our bond yields will be higher because we're expecting higher inflation, and therefore our mortgage rates will be higher. Okay, and if our mortgage rate will be higher, I don't see how that helps our economy, our real estate market either. So either way, we're seem kind of like our real estate market is seems stuck in the middle, right? It's very hard to imagine a scenario where it's going to help the real estate market next year, because if the economy is bad, we keep the interest rate down like the government wanted, but when economy is bad, who's going to buy expensive real estate in Toronto? If economy is good, then inflation expectation goes up, then bond yields goes higher, then our mortgage rates goes up, then that doesn't help with the real estate market either. So either way, we're kind of stuck in the middle of a bad situation for our real estate market. So that's my real concern, okay, about this budget. Is just too temporary, too kind of a band-aid solution. It's not solving like real problems for Canada, and which is what we need to see for our real estate market to recover, right? And also from the federal debt to GDP ratio, you can see that the 2025 federal budget is keeping about the same. So the debt, you can see, is not getting any less, right? It's keeping up the 43% even by 2030. So we're going to continue to have a lot of debt. Basically a shrinking public sector means that we're not going to cut some government workers, like the public service employment is projected to come from today, 2025, like 350,000 level down to maybe 320,000. But like this is more like a less than 10% cut of the public service jobs, right? In my opinion, given how much has came up, I'm not saying public servants, public jobs are not important, okay? I do think having a strong workforce in the public sector is important. But given how much jobs we've created in the past, from 260,000 to 360,000, like we basically increased public service jobs by 100,000 jobs, okay, in the past 10 years. I feel like just cutting 30 is not gonna do much. And because of the chart we saw before, Canada is so underinvested comparing to the US in the past 10 years. So in this budget, we are very focused on investments. The federal capital investments in billions of dollars. They're saying in 2025 budget, they're going to invest more. But all these investments, a lot of them come from borrowing debt, right? So basically, they're saying that to solve the next few years' problems, to create jobs, to keep the economy stable, we're going to borrow money to invest and just locally, let's create more jobs, let's keep our economy strong, but we're gonna borrow more money to make that happen, right? So it's kind of like financing a furniture. You go to a store, you're like, okay, I wanna enjoy the furniture now. It's just like, I wanna have more investment today. You know what, let's borrow money to buy the furniture, right? Just how the government is thinking. It's about its investment strategies, which investments are important, but also the risk from higher borrowing, it's the reason that it's putting Canada into a lower borrowing, like a credit rating, right? And remember, lower credit rating, it also increases our borrowing cost, okay? So we're talking about lower credit rating next year may increase our borrowing cost. And if the economy does well, inflation expectation goes up, it's going to also increase our borrowing cost because the short-term debt needs to roll over into the long-term debt. So likely we are going to see higher borrowing costs next year. So that means for real estate owners or real estate buyers, we're going to be facing higher mortgage rates next year, at least on the fixed terms. And that usually, pull down our real estate market even more. So, and we do have an export problem. Like right now, like you can see, 2025, we're already seeing the lower exports to the US from the tariffs, right? Like we haven't seen a level this low. And I mean, part of the budget, we're going to spend a bit more money on weapon systems. It's saying that permanent resident admission, okay, will be set at 380,000. We all know immigration is important. So 380,000 annually from the next 3 years. So the last few years, the Trudeau government has ramped up the PR admission to 500,000 per year. Okay, so next 3 years is gonna be 380. Okay, it's not bad. You know, it's still a lot of people coming into Canada, so we still have good, solid immigration. Our projected population growth is not gonna be anywhere near the 3% in the past couple years, right? We're gonna expect a 0.9% annual percentage of population growth. I mean, we're still growing. Growing is good, but it's nowhere near the past speed. And the federal government will further reduce the inflow of temporary residents. Okay, so next year, admission for temporary visas will tumble to 385 from this year's target of 673. Almost reducing by half. Okay, so that's where the real cut is cutting away more temporary residents who, can't buy real estate anyways, but they do increase rental needs. But I personally think it's a good thing just to keep our population more in a healthy, controlled increase instead of just, everybody come, there's no jobs here, you gotta find your own food, right? That's why it's causing a lot of safety concerns in Canada, especially the major cities like Toronto, where a lot of these temporary migrants come in here with nothing to do, right? But to cause trouble. But in general, we can see that Canada mortgage arrears rise to the highest rate in nearly 5 years. So our mortgage arrears are going higher, though still lower than financial crisis level, but we are trending up for the past 5 years, right? Just more delinquencies. And you can see that mortgage arrears higher at most big 6 banks, which means that the entire national level is this. And also population does not equal to home price increase. You can see that the biggest home price increase actually came during COVID, or the least amount of population gain. And the biggest population gain did not translate to real estate price gain. I mean, it probably helps with rental market, but it does not drive price higher, at least in the short term. Okay, so you can see that even though our population is still expected to grow, it's not helping in the short term. So don't expect the 380,000 new immigrants next year is going to help with our condo market, for example. Don't count on it, right? It's not a direct correlation. In the long term, it will help, but in the short term, it's still the fiscal policies, interest rates, inflations, and most importantly, everybody's mindset, our expectation for the future. Do we see a better future or do we not, right? And that's the most important thing, is going to affect investor or purchaser's mindset and whether they're going to, decide to buy that house or not. Okay, so just wanted to share my thoughts on the most recent federal budget and how it's going to impact our next year's market. Stay tuned. Until next time, subscribe. Ciao.